This is the official welcome. Welcome everybody. Thanks for coming tonight. My name is Kelly Clement. I'm with MetaStock. I'm pleased to introduce tonight Jeff Kilian, our speaker tonight. But before we get there, we just have a few things we need to take care of. If you've been to our webinars before, you know the first thing we always have to do is quickly just read this disclaimer. So bear with me for just a moment and we'll get through this and then we'll move on to introducing Jeff. This presentation is designed to introduce you to using MetaStock and accompanying software and data. It is not intended as a recommendation to buy or sell. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with these companies. Okay, so we're done with the disclaimer. Let's go ahead and introduce Jeff. Jeff is the owner and CEO of a company called the InsideTechnician.com. I had the link there up on the front page. You can go to that to see his website and go through it. But Jeff is going to be talking to us tonight about some of the ways of becoming a profitable trader. So some of the things he's going to talk about tonight is really looking for where the smart money is, how to follow them, how to use risk management in your trading, and really how to use some of the most time-tested indicators as some of the best indicators.
Hey everyone, can we get a sound check and see if
Jeff,
everyone can hear me okay?
Has the philosophy of the simplest methods are the ones that work the best. So let's go ahead and turn over to Jeff, let him guide us through his presentation, and we'll get started. Jeff, turn over to you.
Well, good evening everyone, and the first thing I want to say is I want to thank you for taking your time to be here with us with the expectation of learning something new and something that you can immediately incorporate and use into your techniques, into your methodologies to become a better trader or investor. My name is Jeff Kilian and I am the founder of the InsideTechnician.com, and I believe there are real opportunities to become a real profitable trader. And through the years, the 13 years that I've been trading, I have discovered that the simplest methods are the ones that work the best. Time-tested indicators, time-tested techniques, the ones that worked 75 years ago, 50 years ago, 5 years ago, and a month ago on the last few winning trades I had. So let's talk about your foundation as an investor or trader, and I believe that learning the correct application of technical analysis is really the foundational skill to become a trader. It is an opportunity, it's very real, and it's yours to have if you're willing to go through what you need to go through and realize that everything in life is a process, and so is your learning when it comes to becoming a trader. I believe that if I matched and model what professionals did when I first started to study 16 years ago, and that helped me, I believe that matching and modeling is one of the best ways that anyone can really learn the most important things to become a trader and a real investor and make money doing it. Here, I believe that it's possible to advance from a beginner to the intermediate level in a fraction of the time and really live more of the life you want by incorporating the most time-tested principles in trading. I believe that technical analysis is the preferred method to analyze and trade. And we basically study the price movements within price charts, and we use mathematical indicators based on price, time, volume analysis, chart patterns, trend lines, really to just determine the current state of any market or security and then the greater probabilities of its future price directional moment. This is the true value of any indicator that you're using. Always remember this. What is its ability to predict future directional price movement? And whether you incorporate fundamentals, systems, technical analysis is the preferred method to use to determine if there is a real opportunity or not, because it's 100% objective. And that means that it can be quantified and determined to be the truth. It actually happened, and therefore it becomes something that we can use as actionable intelligence to get into positions, get out, limit our risk to a very small amount of money. When there is no opportunity, stay on the sidelines and wait for the next one. And this is your greatest positional advantage as a trader or investor, is that we have to wait. And if there's nothing there, we do nothing. And if there is something there and we have a high probability trade, then we take it. Technical analysis will reveal the true supply and demand, regardless of what those fundamentals are reporting, or the news is on CNN. Everything that you're seeing on the TV is more or less geared to confuse you. It's there to take you off course. And so therefore, the right techniques, multiple indicators and multiple time frames, volume, everything lining up, that is the truth. And therefore, we can act on that. And if you're going to combine that fundamental analysis with professional technical analysis, really your trading and investing becomes so much more profitable and risk adverse that you can be wrong 3 times and make 2 trades and make more than enough to bring in what you need to bring in every month. The business side here, we offer one-on-one coaching, and that means really it's developmental training. And this is the source for developmental training here, because this is the preferred method to learn. I think that a lot of us, when we were younger and new into the business, and I know there's a lot of traders here tonight, very savvy people. I appreciate you coming. That we had an opportunity to study, and we got a course. We signed on for a seminar, and you didn't really get as far as you wanted to. And the reason was that the best method, the most time-proven method to learn and absorb and actually use, put into practice what you've learned, is one-on-one developmental training. So this is why we've taken this road. The second opportunity is the Foundations course, and that allows a beginner to get up to the intermediate level in a fraction of the time. We'll get into all that later, but what we're really willing to do to educate ourselves not only develops us and helps us, but it helps the lives of our families to come. And even in the best schools in the world, now they have regular courses, mandatory courses to learn about trading. And I believe here you'll learn the correct application of technical analysis to assess not only the current state of any stock group or sector or the market, but the higher probabilities of, again, its future directional price movement. And even, you know, if you have a financial advisor who manages your money, a lot of times the fundamentals will be early, and you can help time those buys and sells by studying technical analysis, even if you're a fund timer, to be able to have more informed and intelligent conversations with these people with regards to your investments. So this is something very important. And again, buy and sell decisions based on just the fundamentals should be a thing of the past. And they should never be the same again without using rule number 1, and that is when. Tonight we're going to cover an analysis of the Dow. We're going to get into it real quick here, and we're going to talk about how we got to where we are today, what's the current state of the markets, and what's the real possibilities for future directional price movement. And after that, we're going to do a trade examination of an actual trade that myself posted on YouTube shortly thereafter. And we're going to talk about how we arrived at decision to trade, what the risk-reward ratio was and how that was arrived at, and how we really find the smart money. Because at the end of the day, we need to find the insiders, the institution people, the guys that are inside the market that control stock prices. And we let them make their move. And then we make ours immediately after, full well knowing that everything is lined up. So let's get out of this here, and we'll switch right over to MetaStock. Can everybody see that clearly? Okay, excellent. Okay, what you're looking at is an end of day chart of the Dow Jones Industrial Average with 21 period average daily volume overlaid on the volume in the subgraph below. Volume is a catalyst behind the biggest moves, whether it's the market, the sectors, the groups, the individual stocks that are leaders that actually turn things around. And I don't trade without a lot of volume because there's no need to. If you have the patience to wait, you can. So let's take a look here at, we'll go back to about the end of November, early December here. Prices had actually moved up in early December because of a lot of so-called fundamental news that had come out that we were in the clear. But as it stands, here's our volume spike right here. And I called this on a previous webinar that this was accumulation. And so prices moved all the way up at a nice long run all the way to the end of the third week of February. Prices turned back around on a good sized short-term correction. We had a strong volume spike right here. And prices moved all the way back up to just about the open here of the big down bar, and then again here a little bit of accumulation here, and which pushed us all the way up to about the 12,800 some odd level, and then prices have corrected back down. And I believe that this volume spike right here is somewhere mixed between an accumulation and sell-off, because we're at a critical point in the market, and I'm going to explain exactly why I feel that way right now. I like to know when I can see these turning points in the market clearly. And aside from the chart patterns, you know, the pivot point, highs, lows, swing highs and lows, as in this area here, here, and here again. I employ 4 and 8 day exponential moving averages, and I overlay them on the Dow, and on the stock side I do 3 to 7 day exponential moving averages because they hug those turning points, and that's where we need to be. We need to be able to determine exactly when we can be in after the turning points are confirmed. So keep that in mind. Right here we have the Jacobs advanced decline oscillator, and we can see at this point right here we had a negative divergence, and the oscillator itself had moved way down. Now, one thing I want to talk about on the indicators is that don't get hung up on the values of the indicators. The actual values that they're, or levels that they are at. The direction of the graphed line, divergences, whether positive or negative, are the most important thing for us to look at as they are compared to the price action of the chart above. So here we had a slight negative divergence, sell off here, big bar down, sideways movement. But in the meantime, prices are moving sideways. The advanced decline oscillator is signaling a huge downturn. Okay, and sure enough, at this point, that was the last of the sell-off. And as you remember, there was a big volume spike here that I showed in the beginning that brought us back up. Let's take a look at the standard MACD indicator. And here we had, although prices had moved up, I believe on inflated highs, the MACD was still flat. And that indicated to me, even though we weren't on a serious negative divergence, that we were gearing up for a short-term correction. Here's the trend line showing the MACD being flat as prices continue to move up, and here's our sell-off at this point here. And consequently, the MACD crossed from above to below the signal line here and started to move down, continued to move down. And it's not just the indicator itself, it is the momentum, the directional movement of the indicator, the momentum behind it, the rate of change of it, that enables us to be able to confirm what is really going on. So now let's take a look at another one here, our money flow divergence. I don't trade without money flow either. As a matter of fact, I don't trade without any one of the indicators that you've just seen. And money flow at this point from this hammered out high on the indicator itself as compared to this level of prices signaled that the smart money was leaving and we would have a correction. And sure enough, we did have the correction. The money flow has come back up here, a huge spike right here, indicating that we would have a future price move up on the Dow, which started here. We need to understand that a lot of times, more often than not, the insiders, the institution people, buy in bulk before the prices move in an upward trend where they actually stall per se at this point and start a new uptrend from a short-term correction. So keep that in mind. And as it sits right now, we want to compare money flow and we want to compare that to prices, but we also want to incorporate Fibonacci because I use Fibonacci every day in my analysis for price profit targets, for looking for prices to get magnetized to certain levels and looking for places to get out. So here we are, and I'm going to draw it for you right in real time. At this pivot point low right here, I started to track the upward movement, and I knew as soon as I had this big bar down, I was going to connect this day and this day right here. Now, the initial connect point is 11/30/2010, and the secondary data point is 02/18/2011. So let's do this right here. Here we have it. Now, as you can see, price is corrected, moved sideways, market net neutral, and the correction came all the way down, just a point short of 61.8% retracement level. And when this day occurred, I immediately employed Fibonacci, and I had determined that the market would probably correct to this level because of the huge run up here. Remember, the prices move down a lot faster than they move up. And when they do move down and they form this swing low here, we have the opportunity to get back in, especially with the volume you saw here on a previous chart. So now, according to Fibonacci, we have just laid out a couple of different levels that the market has actually stuck to. So you can see how it applies and how accurate it becomes. So let's use it again. When the points change, I mean the highs and lows, the swing highs, swing lows, pivot point highs, pivot point lows. When we have established new levels, we re-employ Fibonacci and we carry on. For instance, right here, retracement levels again, we connect this data point and here. Now, does anybody think that's a coincidence? I don't think so. Look at this price level right here. This is amazing how price levels get magnetized to what Fibonacci lays out. I've done a lot of research on this, and it is almost uncanny when you incorporate the laws of nature into your trading, what can happen. I'll let that speak for itself. We'll move on a little bit here. Stochastics at this point had crossed from above to below the 80% level. I use a standard 21-day because that works for me out of all the back testing I've ever done. I have found this indicator in isolation to be the most profitable, again, on the signals that it generates on its own for entries and exits. When we have coordinating chart patterns, moved all the way down to here, and sure enough, crossed from below to above 3-day smooth averaged line here, and actually crossed from below to above 20. This is the kind of thing that I look for, just like what happened here as well, across and across again from below to above 20. And at this point, it mirrored the correction, and here We have another correction here that it's mirroring. So at this point, we have a short sell-off coming. I believe that it's not going to be a monumental sell-off. The market is going to take a breather. It's going to take a rest. The big players have made a lot of money in the last couple of months, and they've taken their profits. And now we're going to wait, and we're going to see. I'm on the sidelines because I'm long player, and I'm going to wait and see exactly what the market is going to do in the form of the indicators that we use to represent itself. It's that simple. It doesn't have to be any more complicated. People, a lot of traders and a lot of investors, a lot of news, a lot of fundamental reports want to make things more complicated than they have to be so they can be the ones that can make the money and not us. So these are the ways that we find, track, and capitalize on what the smart money is doing. And once you learn how to track them and how to identify what they're doing, you will too. I know a lot of you are very experienced traders out there, and you may know some of these techniques, but I would encourage you to incorporate only a handful of indicators that I just showed you outside of a few other things that I normally do, to be able to keep it as simple as possible so that when the moment comes to make those trades, you're not overwhelmed and you're looking at things objectively, because this is where the rubber meets the road. So that concludes the market side analysis, and I have a question from Richard Sarapasio. How did you know prices would drop to 61.8? Because of the run-up, because of the exhaustion in the market. I couldn't be 100% sure that it would drop to 61.8, but I employed Fibonacci as a guide to be able to confirm at the various levels on the way down what the real possibilities were when you compared it to everything else that we just looked at. And when we combine all these together, now we have a synergetic approach to view, analyze, and trade. Does that answer your question, Rich? Okay, we'll take some more questions in a few minutes. I'd like to get through this demonstration on a actual trade that I took by myself here. The symbol that you're looking at is First Midwest Bancorp, and it's assigned to the banking sector, and it's out of the Midwest Territory Banking Group. In my database, I have organized about 7 groups of highly correlated stocks. And so it came on my radar screen on December 2nd, 2010. And this was odd because usually, you know, December, nothing is happening. But this year we had made quite a bit of money. And so it was a very interesting year, which leads me to believe that I should never become complacent. And I don't want you to either. We do our work every day. We do our scans. We prepare ourselves. And if there's nothing, there's nothing. And if there is, then, you know, it goes on a watch list and we whittle it down. But anyway, in conclusion, on this particular chart, this came on my radar screen again on 12/2, and it actually came on as level 1 and ready to trade for the very next day. And the reason why it did was because of the way this chart pattern, this stair step down, and this low volatility, base formation, pivot point low, in conjunction with these 3 volume spikes, here's the first, the second, and the third, told me that there was big money in the stock, and this stock was for sure under accumulation from the insiders. So at that point, I was immediately looking to see what's going to happen the next day, whether it was going to be a gap away, a big day up, you know, which would determine my entry and exit, or my entry. And my exit is always determined by Fibonacci ratios, by the way. And we'll get into that too. Right now, I want to show you every time that I get into a position, I know where I'm going to get out before I get in. This is the way this is the way to do it. Right here, I employed Fibonacci at this level right here, okay? And when I saw this pivot point low again, just like the markets, I employed the second data point connected here. Now you have to remember, this is the day. Nobody knew exactly what was going to happen, okay? But as it turned out, and we moved forward in time, the next day was a big day up. These two previous spikes disappeared because of the adjustment in the chart for the following big day up. Now the question becomes, how do I get in? If it gaps away more than 50% of the range of the day that I'm looking at right now, should I get in? My answer is no. I'd rather get in on a correction, get a fill at where it closed, or the high for the day in this case, and then ride that up, because there's no reason to overpay. And sure enough, the very next day, right here, is where I got in. On a retracement, in fact, I got lucky. And I rode this trader for 3 days. 1, 2, 3 right here, and I got out on the third day right near the high. And why? Because it coincided with this Fibonacci level right here and this 2-day chart pattern with this gap down at 38.2%. Now, this methodology, real swing trading, allows us to make a lot of money in a short period of time. You get out, wait till the next trade comes along, the next high probability trade, conserve your capital, and when you get a mirror trade, a brand new trade, new symbol, new group, new sector, doesn't matter, and the market is trading in your favor, then you trade. And I like to get out like this because I know that after this kind of run up, the chances are, my calculations, 90% of the time, prices move sideways, and there I am sitting there with my capital tied up, and I can't do anything because I'm waiting to see if it's going to move up or down. And in reality, from a trading standpoint, if it moves down, I've lost everything that I've just gained, and I've been through that before a long time ago, and it doesn't happen anymore. I want to keep those stops close enough that I don't get stopped out based on a chart pattern, and far enough away that I'm sure that according to the daily volatility calculations that I'm not going to get stopped out, and I'm going to keep riding this position up. So my stop in this case was right about here at 40% of this bar on the stop out, on my protective stop, and my sell point was here, a market order. That's it. As soon as it reached that, I got out. Now remember, when you're going to get out, it's always better to get out on a rally. It's always better to get out when the big boys are selling and waiting to go sideways, because you're going to get your fill, and you're not going to get manipulated by the guys on the floor. So keep that in mind too. So this is an example of Fibonacci laying out the risk to reward ratio, in this case being 3 to 1. I need to know that every time I'm going to make a trade, if I can lose $1, I can make 3. And this is the way that I personally trade. Some of you trade 2 to 1, 4 to 1, 5 to 1 would be a longer term investor's position, but not me. Because I'd like to be able to get on the sidelines and look for the next opportunity. Because it could be tomorrow, it could be in 2 days, but I have to be ready for that opportunity. So let's move to the next chart. Right here, 3 and 7 day, again, exponential moving averages, prices move down. You're looking at the same chart pattern that you saw on the last chart. And the 3-day crossing below 2 above the 7-day on the big day up. There's your confirmation from the standpoint of the 3 and 7 day exponential moving averages. Again, we want to hit those turning points running. Here's money flow, standard money flow index. Look at this. Here we have a nice divergence here, positive divergence as compared to the chart pattern, across from below 2 above this level here, and strong upward momentum. This was the confirmation that there were big money players in this stock, because it confirmed the volume buys as being legitimate, real, and insider trading ready to go. Here's another money flow indicator from Chaikin, Some of you like to use standard. You can customize them however you want, but the simplest indicators for me always work the best, and I recommend you use them too. It's a 21-day check and money flow here, and here we go. The same thing, only this time on a 21-day, we had a greater strength in the positive divergence of the indicator as compared to the price chart pattern here. MAC, the standard indicator, crossed from below to above right here. And it might be a little difficult for you to see that. So let's take a look at this. And now I'm not going to blow it up. But you can see here, it crossed from below to above, confirming that this big bar up was legitimate and we were getting ready to make a substantial move. Here, stochastics 21-day, no smooths evident, it's invisible. Cross from below to above, signaling the future directional price movement. So here, we have just seen two different examples from a market analysis side. A dissection of the market using the handful of indicators that I've only applied today, and using literally almost the same exact indicators on a stock that I traded, First Midwest Bank Corporation, to be able to determine what were the real possibilities of its future directional price movement and be able to capitalize on that move and make a lot of money in a short period of time. I made about 4% on this trade in 3 trading days. And actually the third day, I think I got out about noon. So it was actually 2.5 days. As far as real-time charts, we don't have the time to go into that today. I'm looking at a 1 minute to get in and out, a 5 minute and a 15-minute chart to determine my entry and exit points. The 15-minute chart is more geared towards Fibonacci levels and being able to get out on rallies and get in at the entry points, days, best trading volume. So again, 2 different examples using the same indicators, and it's pretty obvious that in fact, we really don't need a lot more. If you guys follow systems, all of us that are with us tonight, and you're making money with those systems, let the buyer beware just a little bit and employ some of these indicators to confirm what your systems are saying. You've probably made a lot of money with them and paid a lot of money for them. And there's quite a few in MetaStock that work pretty well. However, without understanding the mechanics of a system, when the time comes, when the day comes, the moment comes to actually place that trade, do you think that you'll have the same kind of confidence to make that trade as you will if you know these indicators and you employ these indicators? Could probably be a little more difficult, wouldn't it? Of course it would. And so this is why we do the homework ourselves, and this is why we study, and this is why we are in a constant state of development. You know, I want to talk about psychology here for just a moment, and I'd like to say that the psychology behind the market is that the insiders, the institutions, control the stock prices. The secondary buyers, people that are coming in like the 3rd day after I got a First Midwest Bank Corporation, are the people who will act as, in part, the catalyst to keep those prices moving up, because this stock actually traded after the consolidation pattern way up. But anybody who had been tracking all the way up to here, and anybody who'd been tracking really the banking sector and the groups, knew that it was wiped out. So a subject for another time. Confirm to see if there's other stocks within the same group that have similar chart patterns, similar indicator formations. The market is net neutral. You can trade this way. You don't have to wait for a strong uptrend. You can trade it as it is laid out and make money. So this is the demonstration that I wanted to share with you today to show you how simple it really can be. And now I want to tell you that, when I first started this study about 16 years ago, I took 3 years off from life and I buried myself. I was talking to people all over the world. What's the most important thing? What do I need to study? Where do I need to go to learn this business? And the answers were always the same. They said, you need a trading methodology. You need to be sure of what you're doing. You need to have excellent money management techniques. And if you do all of that, you will believe in yourself and you will become a profitable trader. So if I had just a few things to say other than what I've demonstrated, I would advise exactly the same to all of you. Depending upon how much time you have to trade, part-time, you have to dedicate enough time to study and actually trade to be able to elevate your level to become a full-time trader. And this process really only takes about 6 months. If you can, it's really one of the last frontiers. People are working a job. The government's taking away more and more benefits every month. We know it. We know exactly what's going on. And this is one of the only businesses left where you can get in for a short amount of capital, maybe 20, 30, 40, 50, $100,000, and actually be successful and make money consistently every month using some of the techniques that I shared with you tonight. So, I'm passionate about this business. I can't think of any other profession that I'd rather do. And, after the 3 years, I was up all night, every night for 6 months writing systems and in programs. And I came to the final conclusion that the simplest methods are the ones that work the best to continue to make the most money time after time after time. So now that we've seen a couple of different demonstrations, I'd like to go back here to this PowerPoint for a moment. But before that, I'd like to answer a few questions. And what time frames are you trading? Intraday only. Okay, I think we discussed that. 1 minute to get in and out. The precision entry of my trades, 5 minutes, 15 minutes, and the 15-minute charts are really what determine the intraday support and resistance levels that I'm looking at to confirm what direction the day is going to go in. Do we have any other questions? We can take a few, please. Maybe not. Settings on MACD and stochastics. Standard 12, 26, 9 on the MACD. 21 period on stochastics. And that's it. If I'm looking at the markets, I might use a 3-day smooth for a crossover. But on stocks, as you can see right in front of you, I'm using a singular graphed line on stochastics 21-day. Ben, is there any rule of thumb for fibs and different time frames? The rule of thumb is that we need to establish those Fibonacci points at established swing highs, swing lows, pivot point highs, and pivot point lows. We need to have an established area where the market is clearly in a point of indecision, more than likely, and it has to make a decision about where it wants to go. And once we establish these levels, now we have a guide, like I said earlier, to go by. It's not always 100%. There is no crystal ball in trading, but it is highly accurate. I can attest to that. Do I have thought where the market will drop using Fibonacci? I can't go back to that chart right now, but if you want to email me, you can, and we can address that. No problem. What do you use to screen stocks that are close to filling your entry criteria? Colonel Sanders. Excellent question. The first thing I'm looking for is I have scans on volume. Volume as related to chart patterns, like I mentioned earlier. A nice chart pattern that has trended down here, low volatility, nice small range days, and that have established a pivot point or a swing low with small range days right here with the volume and everything else that you just saw in anticipation of a substantial move to the upside. But my screening first and foremostly is price levels. I'm looking to trade stocks that are between $5 and $20 to $25. And those $5 stocks could have been 30, 40, or 50 before. They just got completely washed out. And now it could be the leader for the turnaround of the actual group that it's assigned to, and then things will follow, and consequently the sector will move as well. Because I don't know whether I found the first one, the secondaries, or the third ones if I'm into a brand new group or sector for the first time on a scan that's showed up a brand new stock. And Boris, Patrick Roy, but your chart is for 6 months. I don't understand that. The standard loaded up data on a chart that I'll look at is 6 months. My volume scans are end of day. Every day at the end of the day, I'm looking for what's happened today. I hope that answers that question. So now we're going to finish up here with a final PowerPoint that I'd like you to be able to take a look at and remember from. And this is going to be your winning traders checklist. Winning trader investor checklist. Remember that we need to have a well thought out plan, like a pilot's checklist. If this happens, then what do we do? And if that happens, what do we do? It's called redundancy in military terminology. Backup plans, so that when you run out of what ifs, you've left nothing to chance. So therefore, when you have it set, you have the discipline to follow that plan again when the moment arrives. You need to have sufficient investment capital to trade, because if you don't, like 10,000, it's not going to last. So wait until you have a little bit more and you can take the small drawdowns and not get shaken out. You need to have a solid working foundation of technical analysis, which is what we teach here, and we need to have excellent money management techniques. We need to be open-minded with a positive mental attitude. And a lot of ways to do that is to create your own environment, not the one that life wants to give you. A trading environment is, yes, it's very isolated, but once accomplished, it's very profitable. You have nobody to answer to. You answer to yourself. And like I said on my website, you live in acceptance of that because you've made your own way. Again, all the trade-related decisions have to be objective. No room for subjectivity here. So basically, again, to finish up, we offer 2 services here. And the first is one-on-one developmental training. And I believe that the difference that we offer versus any other company is that no matter what your level is, we can tailor a program specifically for you. Every session is very similar to this. It's all recorded. It's you and I talking in real time. I can answer your questions on the spot if you have clarities, and we go ahead and we make something that could appear very complicated and take a long period of time very simple and attainable in a short period of time. Obviously, all those lessons are yours to view on demand whenever and wherever you like, as long as you have an internet connection. And the second thing for the new people that are trading with us is that we have a foundations course. This is a highly structured, very comprehensive course, and that enables the beginner to get up to the intermediate level really in a very short period of time, and guaranteed. So I believe through the years, the very short period of time, the 3 years I've been trading traders, new, intermediate, and troubleshooting out professional traders, that this is where you really can become a real life professional trader. Now, what I'd like to offer tonight is a copy of all these PowerPoint slides so you can have them for yourself. So all you need to do is go to theinsidetechnician.com and go to the registration area for the bi-monthly Inside Market Analysis webinar that I give outside of this, what you've seen tonight. We do a bi-monthly, every 2 weeks, a webinar that goes through the market and analysis, yes, with a call on its future directional price movement and a recent profitable trade that I've taken. And you'll learn from it. There's a lot of actionable intelligence. As a matter of fact, there's a wealth of information here that any trader or investor can benefit from. So again, you'll get a copy of these slides. All you have to do is log on to theinsidetechnician.com and go to the registration area for the Inside Market Analysis webinar. Make sure your email is correct, and I'll get it out to you early next week. So again, this is Jeff Kilian, and I really do appreciate all of you taking all the time to be here with me tonight. And I want to thank MetaStock for providing the Inside Technician the opportunity and an incredible software program with, I believe, a technical support department that is second to none. So thank you, everyone. I look forward to seeing you on my Inside Market Analysis, and we'll see you shortly. Thank you, and have a good night.